What's up everyone, it's Matty from Logic Effects, and in this video I'm going to be covering a famous Forex trader. He's been in institutions for many years now. He's worked in various funds and banks as a Forex trader, and we're going to go over a little bit about himself and any tips that we can actually get from him as a Forex trader, because he's actually called Colm O'Shea. Colm O'Shea. He's a Forex trader famous for his 31% returns during the 2008 financial crisis, and this exact time was when other funds in the world were actually going bust because all their positions in the world were just losing. But he was out there generating returns in the Forex space using a global macro trading approach, and he's actually profited from the financial crisis itself. So his timeline went a little bit like this. He graduated from Cambridge studying economics in 1992. He then worked for Citigroup as a Forex trader during the ERM crisis, which we'll go into a little bit later. He then went into working into the Quantum Fund. If you're a Forex trader, you probably know that this Quantum Fund is famous for being George Soros's fund. And afterwards, he actually then went and founded his own fund called Comac Capital, and it's a London-based discretionary global macro fund, and it focuses on directional market movements that commonly have a strong fundamental reasoning based on economic and political analysis. So let's take a look at some of his traits as a Forex trader and what actually makes him such a good trader in this space and what we can actually learn from him. So here's a few points about Colm O'Shea and what actually makes him a great trader. He is wrong at least 50% of the time. So unlike all the other online gurus, the online traders, they're all promising those ridiculous returns and win ratios of like 70, 80, 90, 99% win ratios. It doesn't actually matter to him. It doesn't matter to O'Shea, because O'Shea focuses on risk reward. So when he's wrong, he loses less, he loses little, but when he's right, he wins big, and he makes sure to scale in when he's winning, because that's when all the big bucks are made. And this is why having a 50% win ratio or even lower is actually sustainable, because he understands that this risk reward is what matters. It doesn't matter about the 70, 80%, 90% win ratio, because even with those win ratios, you could be losing money. Okay? He's a global macro trader, and this is a strategy style that actually seeks to profit from the anticipating directional trends in either currencies, interest rates, equities, commodities, and it's actually what we teach here at Logic Effects. So if you want to learn more about fundamentals and how to actually implement that in your own trading, we are actually running an online web class to showcase this a little for you. It's free. Go ahead and sign up for it, and we'll teach you a little bit about fundamentals. And if you're actually really serious about getting into fundamentals, we'll give you a little call to see if you actually cut out for it or not. So an interesting outlook that O'Shea has towards trades is that he thinks of his trades as hypotheses, a bit like a science project. So if the market moved counter the expected direction of his hypothesis, this would prove his trade is wrong, and he's absolutely completely fine just closing it there. He always places stops at points where he believes his hypothesis is incorrect. Okay, he doesn't place stops on pain thresholds. He doesn't place stops on pips. He places it where he believes his hypothesis is incorrect. Okay. He risks small on his trades, so he actually mentioned his risk on trades is a small percentage of his assets under management, and he prefers to trade this way because he prefers his losses to be a small percentage of his total assets, and when he wins, he risks more by scaling in on those winning trades. So one thing in particular that he mentioned, and it actually caught my eye, was his analogy towards fundamentals and technicals, because there's always this big argument online about what's better and what's good out there. And coming from Colm O'Shea, a professional Forex trader who's worked in various funds, worked with George Soros himself, he mentioned this: people get all excited about the price movements, but they completely misunderstand that there's a bigger picture in which those price movements happen. Price movements only have a meaning in the context of a fundamental landscape. He uses this sailing analogy. Okay? The wind matters, but the tide matters too. If you don't know what the tide is and you plan everything just based on the wind, you're going to end up crashing your boat into the rocks. And that is how he sees fundamentals and technicals. And he mentions you need to pay attention to both to make sense of the bigger picture. Okay, considering he's made millions trading Forex on an institutional level, his advice and his analogy is absolutely sound. And traders out there really need to understand that both technicals and fundamentals are important to understand the bigger picture. If you're just doing one of them, or you're doing one or the other, you'll never understand the big picture and you'll forever be lost. Okay, and this is really important because all the beginners traders out there that I know, they always set out their trading journey just focusing on technical analysis because it's easier and it just looks a lot easier to do. And an important rule that I've always mentioned is don't just do something because it looks easy. Don't just do something because it's easy. Research what's right. Okay? And in this case, as a trader, as a Forex trader, if you want to be serious, you need to understand both fundamentals and technical analysis. Okay? And that's not just coming from me, Matty from Logic FX. That's coming from Colm O'Shea, who's managed millions and millions of dollars. Okay? So let's go on to say what he has against the free markets and policymakers. So, as I did mention, Colm O'Shea's one of his first jobs was a junior trader at Citigroup, and this is where he experienced the day the British pound got kicked out of the ERM, which is the exchange rate mechanism, and it's basically the day which saw the pound plummet, and it's the day that is famous for George Soros breaking the Bank of England. And basically what Colm O'Shea mentioned is that he was so adamant that the pound would never break out the ERM that he soon to find out that he was completely wrong. And the free markets went completely against the policy of the British government. Okay? So this created a huge impression on O'Shea because he actually learnt that the markets matter more than policy, and you really need to look at what the real fundamentals are doing and not what policy makers actually want to happen. Okay, because sometimes there can be speculators out there that can actually just force it on the free markets to do what they want, and the policymakers might not have enough money in the bank to actually uphold their policy. So trades only matter when people care. An interesting point Colm O'Shea mentioned was about his trades, and that his trades, he only cares about them once other people care about it. For example, he mentioned, would you short the Nasdaq in 1999? And this was during a massive bull rally and it was continuously rising. The obvious answer was no, because you'd lose money, your trade would have hit your stop, and that's what would have happened. He mentions, you can't just short something because you think it's fundamentally overpriced. You need to wait until people start to care. And he further went on to say that by selling the Nasdaq at 4,000, but only once it's reached 5,000 and it's on the way down, would be the play. Okay, if you don't understand that, he basically said, if you want to be selling something on a fundamental level, but the market's going up, just wait for it to go down first. Highlight the level in which you had your idea, highlight the level in which what price it breaks at, this is the price that you want to sell. You don't sell it while it's going up, you sell it while it's going down. Okay? Because in a bubble, no one can say how far a market can go, and you always need to wait and recognize the right time. This is really important for traders to understand because loads of traders I know will go out there, instantly place a trade based on a few rules, a few requirements, but fail to wait for the market to agree with their ideas. This could be something as simple as, oh my god, price has hit a support level, I'm going to buy it straight away. No. Wait for the market to agree with your idea. You need to be disciplined, wait for people to care, and wait for the market to agree with your idea, because until then, it's completely useless, okay? So implementation of trades. One of the first ever trades O'Shea made was for Citigroup, where he was only allowed to trade on small limits. And what he did was he did a great fundamental analysis on the UK, predicting that the expected interest rate hikes that were priced in on the markets weren't going to happen. And he was absolutely correct, and the market dropped 100 basis points. But he lost money. Why? Why did he lose money? His implementation of the trade was completely wrong. Okay? The forecast was a 1 to 3 month time horizon. but he kept trading in and out because he was scared to lose money. And that's what he actually said. What he realized is you need to embrace uncertainty and risk, especially over a 3-month period, because it's the trend that's important. This is really important for all you traders out there to understand, because what you'll tend to see with traders is they'll be getting in and out of trades because they have a fear of missing out, or they've got a fear of losing money. What we need to be doing as traders is understanding the fundamentals, understanding the technicals, and then embracing the uncertainty and risk to actually get hold of your emotions, or else you'll be trading in and out, you'll be racking up those commission costs, and you'll just be losing money on the way, okay? Here's a few points about bull markets and bubbles that he mentions. I'm personally not a fan of trading bubbles, but O'Shea did mention some useful tips that even I've taken on board, and one of them was this sentence: sometimes a reason for a bull market is psychological rather than fundamental, and participating in the euphoria of a psychological move itself could be the rationale of the trade. He then went on to say that what I have difficulty with is when fundamentals are in conflict with the euphoria of the bubble. I have tended to be premature in worrying about the conflicting fundamentals, and he says in the next 10 to 20 years he'd want to be doing a better job of profiting from people's irrational euphoria. So essentially what he's saying is that when fundamentals are starting to contradict what the market is doing, he prematurely worries about it, whereas what you can be doing in the meantime is just profiting, participating from the euphoria, and then getting out when the market confirms your hypothesis of the fundamentals. Okay? So traits of a successful trader, and this is where I've tried to, dig deep into what Colm O'Shea said, what type of traits are required, and it just really came down to these 2 points which he's mentioned. He mentioned that perseverance and emotional resilience are key to keep coming back, because as a trader you're gonna get beaten up. Okay? So if you don't have perseverance, you don't have emotional resilience, make sure to be building those up. Make sure you can allow yourself to keep coming back, because as a trader you're going to get beaten up. And what about trading rules? What does he say about trading rules? Well, he actually mentions traders who are successful over the long run adapt. Okay? If they do use rules and you meet them 10 years later, they will have broken those rules. And why? Because the world has changed. Rules are only applicable to a market at a specific time. What traders fail to see is that when they get stuck in their rules and they work, it's great. But when their rules stop working, they get annoyed. What they failed to see is that they failed to realize the world has just moved on without them, and you actually have to adapt towards what's going on. Rules can't be there forever, okay? So the key points that I've made in this video are these 3 points. Understanding both fundamentals and technicals. So in the boat sailing analogy, you need to understand what the wind is doing and what the tide is doing, or else you're going to crash into the rocks, right? Trade implementation is more important than the idea itself. So confirming that the market is with you or is it against you, making sure that you're not getting in too early or you're trading in and out. And flexibility is a crucial skill for a successful trader. This meaning, don't get too attached to an idea. Always be willing to get out of a trade if the price action goes against your idea or your hypothesis. Okay, that's it for this video. It's Matty from Logic FX. If you're still interested in learning about fundamentals and technicals, we are teaching that online web class about the fundamental side, and our Lita Academy is the all-in-one masterclass where you'll learn everything about fundamentals and technicals, and even sentiment to know whether the market is with you or against you. Hit that subscribe button if you want some more tips and tricks like this. I'm going to be going over some more profitable Forex traders out there, some institutional traders, to give you guys more tips and tricks from those guys, because that's the professionals, that's who we want to be learning from, and that's how we're going to be building a profitable, successful trader in our own minds, and then eventually achieve that goal yourselves. Thanks for watching, hit that subscribe, like the video, I'll see you all soon.